I hate to say this, but lately, much of the advice that I'm seeing on the internet about how to save more money and how to prepare for retirement is just plain dumb. So in this video, I'm going to share with you what the advice is that I think is silly, and more importantly, what I think you should be doing instead to actually really hit your financial goals and to put yourself in a position to retire earlier and to have a more comfortable retirement. So let's jump in. And I think for me, the classic example of this silly advice is we should all quit buying coffee out. We should make coffee at home for 20 cents as opposed to going to Starbucks and paying $5 for a cup of coffee, or going to McDonald's and paying $2 for a cup of coffee, or whatever it is. And the saying goes, if you save that $5 a day and you put it in a Roth IRA and you save it over 40 years, you're going to have over $1 million. And you know what? The math on that is correct, but trust me, there's nobody in America that cannot retire today because they bought too much coffee, right? That's not why people don't hit their retirement goals. The reason people don't hit their retirement goals are much more complex, and I'm going to get into that. But let's tackle this coffee situation first, right? The same argument can be made for going out to dinner. If we quit going out to dinner once a week, we could save $1 million in a Roth IRA over 40 years. But all of these things are what I call affordable luxuries. And if they're bringing you joy, if it makes your day more enjoyable, or if it's a coffee or a meal that you're spending with a friend and you're building relationships and you're feeling joy in your life and you're enjoying your time more because of that, if it's an experience that you enjoy, this is what life is about, right? I mean, if we cut out all the experiences that we enjoy, yeah, we could all retire as millionaires in theory. But it's not the experiences, it's not the adventures, it's not the relationships. It's spending on those things with affordable luxuries, a cup of coffee, going out for breakfast, maybe an affordable dinner. Those are not the things that hurt most of us. The things that hurt most of us just go back to the fundamentals, and we all know these intuitively in our hearts to be true. And that is, the fundamentals are, no matter how much money that you make, you have to spend less than what you earn. Yes, $5 a day for a coffee is going to help you spend less than what you earn, but it's probably not the coffee. It's probably, frankly, the stuff that comes in the cardboard boxes to our front porch all too often, right? We live in a consumer-driven society, and oftentimes it's the things that we buy, and it's the big purchases that we buy, or the mistakes that we make. So let's dive into this. First off, it sounds super simple, doesn't it? Spend less than what you earn, and then save the rest, right? And yes, unfortunately, salaries have not kept up with inflation in the United States, but that doesn't tell the whole story, because over half of all the people in the United States that make $100,000 or more, over half of these people are not saving a dime. And almost 1/3 of people making $250,000 a year or more are not saving anything. So there's something more fundamental going on, right? And part of that is lifestyle creep as we start making more money. And part of it is unavoidable. You know, a lot of times these jobs paying $100,000, paying $250,000 are in more expensive cities, and the rent costs more, or the homes cost more. Maybe you need to pay to park your car, things like that. Your job might require you to have nicer clothes. So some of that is unavoidable, but you know, at that level, we should be able to save something. And if you're in that situation, I encourage you to just start saving something. Because once you start saving and you realize it's possible, then success begets success, and you can continue to do that. So rule number one is I don't care how much money that you're earning, we have to spend less than what we earn. And unfortunately, it's not enough to just save. We also have to invest that money. We got to get compounding working in our favor. And unfortunately, compounding cuts both ways. If we're making a rate on our money that's greater than inflation, then each year our money is working harder for us. But if we're making a rate that's less than inflation, unfortunately, each year our money is working less hard for us. So we need compounding to be working in our favor. And for most of us, that means to invest our money. That unfortunately, that warm, cozy feel some of us get having our money in a FDIC insured bank account. Usually those accounts do not pay more than inflation. There's times, like as I record this, some bank accounts are paying higher than what the current rate of inflation is. But for the most part, your bank is paying the rate of inflation or maybe a little bit less. So we need to break out of that warm and cozy feeling and have some exposure to stocks in order to have a chance at growing our money at a rate higher than inflation. Now, none of this is financial advice. I don't know your situation, but the general goal of trying to keep up and beat inflation is a theme for how to build your net worth, because they say that saving that first $100,000, saving that first $200,000 is the hardest. And the reason they say that is after that, now you've got that base of $100,000 or $200,000 that's also earning along with what you can save. And so that's our goal. And no matter how much we save and invest, it's still important that we don't make silly mistakes. Oftentimes, this is how people get hurt, is it's our own mistakes. It's called behavioral economics. It's the decisions that we make. And multiple studies have shown, there's a famous think tank called Dalbar that talks about what they call the investor behavior penalty. Keyword there being behavior, right? We're the investors. And what Dalbar is saying is there's a penalty to our behavior because unfortunately as humans, we're wired for, from an investment standpoint, left to ourselves without discipline, without some structure to our investing and without a plan. It's just human nature to react to greed and fear. So when the stock market does well, we're thinking, I missed out. I need to catch up. I need to invest. And when the stock market's down, it's just human nature to say, I don't like that. That's painful. I don't like losing money. Of course we don't like losing money. So we move away from that. And Dalbar would say that that behavior penalty costs us, anywhere from a fourth to half of the returns that we should be getting. And over 20, 30, 40 years, that becomes real money. And that is what is causing people to get hurt a lot more than investing in affordable luxuries, like going out for a cup of coffee, like having a nice meal with your friends, like spending some money to do something nice on a weekend that's an experience based. Those are affordable luxuries. If we can avoid the mistakes of greed and fear, if we can avoid the mistake of the pain of a loss in the stock market causing us to blow out at exactly the wrong time, if we can avoid the mistake of comparing ourselves to our neighbors, and just because they buy a new car, then we feel like we need to buy a new car, or they move into a bigger home, then we feel like we need to move into a bigger home. It's this lifestyle creep, it's this comparison, and it's, again, as Dalbar would call it, the investor behavior penalty that causes us to make mistakes. If we can avoid the mistakes, if we can focus on the basic blocking and tackling, that's going to move the needle. And what's not going to move the needle is going out for a cup of coffee with your friends and enjoying a nice morning with them, enjoying a nice conversation with them. If you enjoy this common sense approach to preparing for retirement and being in retirement, then I know you're going to enjoy this video here, which is 7 things that I want you to stop doing in order to enjoy your 50s and 60s more and enjoy your journey up until It's time for you to retire, and it's time for you to reap the rewards of making good decisions and doing the right things. I'll see you in this video. Thanks for watching this one. Bye-bye.